The housing market has finally cracked, and in today's video I'm going to be taking a look at the various signals and data that suggest that the housing market is in trouble. I'll also be taking a look at why these early signs of weakness in the housing market could potentially lead to a full-on housing market crash, but also some counter-arguments to this and why this may not actually happen. So let's jump right into it. So what is happening in the market at the moment? So let's jump right into the current housing market data to have a look at the direction that the market has been heading recently. And to do this, we're going to be taking a look at the average price trends, the number of listings having price cuts, as well as the total number of houses in inventory. So I'm going to be focusing mainly on the US housing market for this, as this is the biggest housing market and the one that we have the most data for. It's also the one that usually dictates the direction of other global housing markets as well. So first of all, the CME US Housing Futures Index is at an all-time high pretty much right now, and since the pandemic started in March 2020, it has been accelerating at a faster rate than we've ever seen before. There is one main takeaway from this, and that is that the housing market in the US has been red hot over the past couple of years, and if we are to experience a reversion to the mean in this, then we will see a drop-off in this index. There's no guarantee that this will happen though, and a mean reversion without the market crashing can most definitely still take place. For example, prices could totally stagnate for the next 10 years or so, and this would also be a mean reversion without an actual full-on housing market crash. Now, 2021 saw the largest annual change in house prices in recent history, experiencing a 18.8% increase for the year. And this did follow 2020, which was also a very strong year for house price appreciation, experiencing a 10.4% increase in this year. So the reason why this is interesting is because house prices have rarely appreciated by over 10% historically, and have only done this in the year 2013, as well as the years 2006, 2005 and 2004, which shortly followed the Great House Market Crash in 2008. And we have just experienced back-to-back 10% plus gain years, which is quite extraordinary. And if we're going to judge it based on what happened shortly before 2008, then this is a little bit concerning because it signifies that we could be on for a significant drop in these prices if the trend follows what happened in 2008. So that was the current state of the market. So now let's look at the early signs that the market is starting to crack. So the first sign that the market is starting to crack is that price reductions are starting to increase significantly, and there are two separate sources that show that the number of currently listed houses having their price cut has started to ramp up throughout May and June, and this was particularly higher than in the year of 2021. So it is still quite early on in this trend, and we could see it start to sort of plateau out, but a rising number of houses that are actually having their price reduced signifies that sellers are having a hard time selling compared to before. Now this could be just because there are more sellers on the market compared to before, or it could be that there are less buyers, or a mixture of both. But either way, it does show that the housing market has started to cool off a bit. So secondly, inventory levels are also increasing, as can be seen in the US total active listing count chart by the Fed. So looking at the inventory increase across the US between the end of March and the beginning of May, we can also see that there are far more states with an inventory increase compared to an inventory decrease. So all of this does further suggest that the supply is starting to outweigh current demand, and that people are actually struggling to sell their homes, meaning that the inventory is starting to build up because of this. So if this does continue to happen, then there will be such an excess of supply that sellers will become desperate to sell their house, and they'll start to really drop their asking price, which will further contribute towards the falling house prices overall. Now, on top of this, disposable income has also recently plateaued and is starting to gradually decline. So if we look at the disposable personal income per capita on a real basis, it has dropped down from the highs experienced in 2020 and 2021, when people were getting essentially free money from the government with the stimulus checks and whatnot. And it is now approaching the levels that we saw in 2019. So this may not seem like a big deal, but house prices were a whole lot cheaper in 2019 compared to today, but people now have a similar level of disposable income to 2019. And this could get lower if the disposable income does continue to follow this downwards trend, which I personally believe is quite likely to happen when we factor in the current economic climate with the high inflation, rising fuel prices, energy prices and whatnot. Now, the Fed interest rate is also a significant factor in determining the direction of the housing market, and the higher the interest rate is, then the higher the mortgage rate is on average, making it more expensive for people to borrow money to buy a house. So this ultimately usually leads to a drop in house prices to compensate for this more expensive cost to borrow money. We can observe interest rates starting to go up in the US, and it's having an immediate impact on the average mortgage rate for houses in the US. So the average interest rate on a 30-year fixed rate mortgage is now above 5%, which is significantly higher than the lows of around 2.7%, which we saw in 2021. So this is going to put downwards pressure on house prices, as borrowing money costs more for people looking to buy a house, and this therefore makes houses at their current prices much more unaffordable. And as I mentioned before, we'd estimate that actually house prices will start to drop to compensate for the higher cost of borrowing money. Now also, the real estate market does usually lag behind the stock market in terms of performance, and recently we have seen the stock market drop quite significantly, especially since the start of 2022. So stocks are now far cheaper than real estate on a relative level compared to back in 2021, as stock prices for pretty much all companies are cheaper now compared to in 2021, whereas housing is still pretty sky high and at close to all-time highs. So this could therefore cause wealthy people to cash out of their property and rotate their capital into stocks, which are now at a more attractive valuation. And this essentially comes to maximising the potential of capital and moving it away from a potentially overvalued asset in real estate, moving it into a more affordable asset in certain stocks, which investors may believe have a better, more attractive valuation compared to real estate right now. So we've looked at why the housing market is starting to crack and how this could lead to a potential crash in the housing market, but it is important to also look at some counter arguments to this and reasons why there could not be a crash. So first of all, some argue that there has been an increase in housing for good reason, as many people have been looking to relocate out of city centres and into less expensive areas which are normally in rural areas. So it could be argued that with people wanting to have more and more flexibility with their living condition, there will be an increased flow in demand for houses as people continue to move from working in office to flexible work from home conditions. And then secondly, young people are moving out from their parents' house at a later age nowadays on average compared to in the past. And part of this is due to the relative unaffordability of houses today compared to other periods of time. So if we see a small decline in house prices, then there is likely to be many young people who are first-time buyers looking to take advantage of even the smallest dip in the market. So this could therefore greatly reduce the likelihood of a significant crash, even if we do see prices drop a little bit. And then also inventory numbers as they are right now are still historically quite low compared to what they have been in the past, despite the recent increase over the last few months. So if we look back at the last 5 years or so, the total number of houses in inventory is still pretty low, which means that we haven't really got any big excessive supply right now, and this is something to keep an eye on, as it could start to build up rapidly if sellers are really struggling to sell their houses. But yeah, overall it's still not super high compared to what we've seen in the past half a decade or so. So that is all for today's video, guys. I certainly feel like the housing market is in a very interesting state right now. I believe there is definitely some weaknesses starting to show in the market, but it's relatively unknown what this could lead to. There's definitely evidence that suggested it could lead to a significant correction / crash in the market. Maybe we might see 10%, 20% correction, maybe even bigger than this. But it's not guaranteed at all, obviously, and we could see the strength in the housing market be maintained over the next few years, even if that does mean there is a slight drop in prices. Either way though, guys, this video is not financial advice. I am not a financial advisor. It's for purely entertainment purposes only. But with that being said, if you did enjoy the video, please remember to leave a like, as that does help out a lot. Also, drop me a comment, let me know what your thoughts are on the housing market right now. Be sure to subscribe as well if you want to see similar videos to this in the future. And with that being said, thanks a lot for watching.